Good afternoon, everyone. Welcome to another webinar on business finance. And today we're going to talk about debt financing, though from a business administration perspective. I think it's important to stress that as well. Before we start, I should definitely remind you all that we are recording this session. So if anyone is not sort of feel comfortable with that or have any kind of legal limitations from your companies or anything like that, you should be aware of this and in that case log out from the session if that is the case. But as I said, we will record it as we did last time. So that is the fundamental setup. Very good. And as I said, warm welcome. We are going to talk today about long and short-term effects of increasing corporate debt. As I said, from a company perspective, very much taking that view and very much from a business administration point of view. I will try to walk through a couple of things and I will give you a little bit more of the agenda a little bit later on here. But first I would like to make a couple of observations, generally speaking, that's just been around in the press lately, which I think stresses the importance of the subject, generally speaking. So the other day in Svenska Dagbladet here in Sweden, we saw that we knew that SAS laid off lots of people. One of the arguments that were actually put up on the headline there is that we can't just bring on more debt, so they need to take other actions. So the thing here is, of course, that making the company even more indebted than they already are was somehow problematic, and it will have long-term effects, not only on the company potentially, but also in the relationship elsewhere. And I think that this is very interesting that we start talking about these issues to a much larger extent now after a little while compared to what we actually have seen initially. Another argument is the bonds issued by several companies, which is sort of a similar way of thinking about it. These corporate bonds that have been issued, which people haven't really put the emphasis on in the same kind of manner as we do with bank loans, which is actually pointed out in this article also from Svenska Dagbladet, sort of also stresses the fact here that we potentially will have a problem with the debt level in the long run. And that is sort of the subject that we will focus this hour on. I will talk and give some input on this for approximately the next 30 minutes. And for those of you then who want to hang on and have a little bit of discussions in groups, etc., we will invite you to that. And then we will have a final summary discussion together regarding this subject on a general level. First of all, I would like to ask you a couple of questions in the poll format here. So you will have a first question popping up here for you, which is sort of related to cash constraints and sort of these experiences that you've had. So have you experienced a cash constraint during the crisis yet? Have you had cash problems in your firm or anything similar? So please, you have three alternatives there: no, yes, some, but not severe, and yes, severe as the alternatives. So these are the alternatives that you do have. I will be quiet for a short while. Okay, let's see here if we have. So generally speaking here, most of you, almost 2/3, you're still in a no position. But some of you, as a matter of fact, a quarter of you have experienced some cash constraints and some cash problems, but not so severe. And some of you, about 13%, you've actually, yes, very severe cash problems. And this is sort of the starting point for bringing in. You need to bring in more liquidity in the short run, and there are, of course, alternatives to doing that. But one of the alternatives that we do have is to take on debt, and that is sort of the starting point to what this is all about. I do have a related question to you, which is more from the debt perspective and the way you sort of move out of this. And I think we will have that question coming up here as well. So, is debt financing during the crisis a considered option in your company? And you do then have three alternatives here as well. No, yes to some extent, and yes, certainly. So I will be quiet again for a short while and see what you have input into this. So here we do have, and this is a little bit different from the previous one, of course, not surprisingly so. 42% of you say no, debt financing is not an option for you. That is not necessarily the same thing as saying that you don't have companies in your surroundings that, of course, see that as an option, and therefore also puts limitations to what's going to happen in the future, which we will discuss in more depth in a while. But almost 60% of you say yes to some extent. So the debt option is therefore in play here. And I think that is important to think about that, and therefore also the subject of thinking about what the long and short-term consequences of that actually might be. And particularly now, we will focus on the long-term consequences in the presentation and thinking about what actually will play out. So thank you very much for that input. And we will proceed from there. Let's see if we can continue. Yes. So the agenda for today is that we had our small introduction. We will talk a little bit about liquidity and solvency, the short and the long term. We will talk about how we normally measure these kind of things and sort of just walk through conventional measures of it. We will then bring up some numerical examples of the impact, and that I perceive as a way of sort of illustrating what could potentially happen during these crisis companies. And I have three kind of companies, stylized ones that we're going to talk about, that is sort of built on different kind of industry structures. We will then bring in some thoughts about effects in the long run, leverage, risk-taking, cash flow issues, and bring up some potential effects on the ecosystem, and with that, I mean the industry, the value chain structures, and take it from there. Finally, then, as I said, sometimes after 1:30, we will have some breakouts for discussions where we can discuss your observations and you can initially, and then we will sum up and have a joint final discussion on this issue at the end. So that is sort of the overall plan. So what we're going to talk about initially has to do then with the liquidity and the solvency, which from my perspective is very much a matter of time. So when we talk about liquidity, generally speaking, we are talking about the ability to meet your short-term payments. That is sort of the framework of what liquidity is all about. So the time frame is very, very sort of short-term from that perspective. That means questions pop up like, do you have sufficient cash at hand? Or do you have sufficient current assets on your balance sheet that can be transformed into cash relatively fast, which means that you can use that one for covering your short-term liabilities, on the other hand. Of course, on the other hand, you also have the option of short-term borrowing in order sort of to manage the short-term payments that you do have in place, and thereby fixing your liquidity of various kinds. Then normally with different kinds of revolving credits and so forth to handle that part. We will not go into detail into the different alternatives that you do have, but liquidity, when we talk about liquidity, we are talking about sort of short-term alternatives and short-term issues related to managing the short-term payments. When we generally talk about solvency, we are talking about the ability to meet long-term losses, but also in the long run, sort of also meeting long-term payments, because the losses and the payments tend to be the same thing. That means issues like we want to have sufficient equity i.e. a sufficiently strong balance sheet, which is what we normally talk about. There is a trade-off here with solvency in the long run, which is related to risk-taking. But you also have issues such as freedom, negotiation power with your customers, and thereby the role of dependence on others outside and what kind of things are actually happening. I'm not going to go into issues of financial distress and these kind of things. There are lots of theories in that area, but I will sort of not bring those things in to this presentation. They will be handled in another session later on. So we are only going to focus on this sort of trade-off generally, risk-taking, and sort of the freedom, negotiation power, customers, that kind of relationship will be on our agenda. So how then, from a business administration perspective, do we measure liquidity, generally speaking? Well, we tend to have a couple of measures overall that we put emphasis on. One of those is the current ratio, where we sort of compare our current assets with our current liabilities. The focus then is, as we pointed out before, that we should be able to translate our current assets into cash in order to meet the obligations that we do have as our current liabilities. Of course, a very short-term perspective on that one, but of course, very necessary, particularly in the situation where we have now when we sort of quickly need to convert these current assets. And the question is, of course, how easily can you transform them into cash? If we want to go stricter into the cash and cash equivalent situation on the balance sheet, we would like then to focus on the cash and cash equivalents in relation to sales as one alternative, i.e. how much sales can actually drop out and we sort of still have cash and cash equivalents to pay. This is sort of one way of thinking about it. Sometimes we call this the cash ratio. There are other definitions of that out there, generally speaking, of the cash ratio, but sort of focus on what we are talking about here, sort of the cash and cash equivalents in relation to sales. Another version of this one is to focus sort of on the employees and thereby the employee expenses, i.e. how much cash and cash equivalents do we have in relation to our employee expenses, i.e. for how long can we in a way then without sort of external financing sort of continue to pay salaries to our employee and thereby measure cash and cash equivalents in relation to the employee expenses. On the solvency side, we do have three measures. I'll see that the latter one there has sort of moved a little bit, unfortunately. The first one and the traditional one is, of course, to measure equity to assets. The solvency ratio, we sometimes talk about as that, soliditet in Swedish, as we talk about. The equity over the total asset base as the starting point. It's sort of very Swedish in the way of measuring it, but that is sort of a traditional approach. Of course, varying dramatically between different kind of industries, as all of these measures of solvency do. Then we do have the debt to equity measure when we're talking about interest-bearing liabilities, which we then relate to the equity position. To me, this is a very natural measure of sort of solvency or a financing mix, because you literally take your liabilities and you relate them to the owner financing of the equity. The other alternative, which is increasingly more common, and particularly common in the finance literature, you're talking about the net debt to equity ratio when you're talking about interest-bearing liabilities and you deduct any kind of financial assets, for example, cash and cash equivalent. So you do have a net debt position in the numerator, and then you relate that one to your equity position in the denominator. The issue here is, of course, that if you sort of need to have a certain amount of cash, for example, and you start deducting that, it probably says a little bit less sort of about the leverage that you do have in play that you need to have, which then is, from that perspective, slightly better with a net debt to equity ratio. Of course, from many other perspectives, the net debt to equity is preferred because particularly if you do have excess cash or excess financial assets available for you, that measure is a better indication of the financial burden that you actually have in the firm. So what I'm going to do now is that I'm going to take these measures and we're going to take a little look at a couple of examples that I've been put forward. These are stylized examples, but they mirror relatively well here the structures that we see in different kinds of companies. So we have normalized income statements and we have normalized balance sheets and try to figure out what is happening given certain impacts. And that is sort of our way of analyzing what is happening here. So we're first going to look at an industrial company where we have standardized here sales of 100, which we will have in all of our examples. We have supplies, i.e. things that we buy from outside. It's not only inputs in a production cycle that we're talking about, because it could include rents and other kind of things that is included in the supplies here. So think about that broadly speaking. Everything else that is not included in the other rows. You do have employee expenses of about 30% of the sales, and you do have some depreciation coming in, bringing you an operating income. You have some financial expenses, some taxes, and a bottom line net income. On the other hand, we do have a balance sheet with quite a lot of fixed assets, as is normal in manufacturing firms, of course. You have a setup of current assets and some cash in order to manage the day-to-day. You have a normal setup of equity and debt, which is approximately 1, the debt-to-equity ratio in this case, and you have some other liabilities of various kinds, and you do have current liabilities. And think about the other liabilities as things like deferred taxes and these kind of things that actually are in there. Initially then, we do have key ratios. We have cash to our employee expenses. That is approximately 13%. We have 4% in cash to sales. We do have a current ratio 1.5, and net debt to equity ratio 0.89, and an equity to assets ratio of 0.35. These are quite traditional levels. However, we are now going to look at the consequences, and of course this is roughly speaking, definitely, and we need to take it for that, but as an input to our discussion. Let's assume that we will have a reduction in sales of 60%. We will have a reduction in supplies of 45%, then thinking about it, more or less of a complete reduction in inputs, and less in other sort of obligations that we do have, such as rents, etc. And we do manage to reduce our employee expenses by 30%, i.e. half of the reduction in sales. What kind of consequences could we then see? And we are only looking at the key ratios here, and of course there are assumptions and so forth going into that. Well, after one period we are talking about here, we will see the cash to employee expenses falling to 10%. The cash to sales actually increases, and this is due to the fact that we are trying to keep a certain cash level in the firm because we need to sort of have that in order to manage the day-to-day cash transactions. The current ratio is dropping from 1.5 to 1.02, i.e. putting us in a much worse liquidity position, as we can see with the 3 first one. The interesting thing then, of course, also becomes to the long-term financing, where the net debt to equity actually increases to 1.36 in that case, and we have an equity to assets ratio that goes down to 0.31. Of course, the relationship you see here is due to the fact that we both have decreases in assets and equity at the same point, which is why we do see smaller effects on the equity to assets compared to the net debt to equity ratio level. But what we do see is that the financial position that we do have after this change that we've seen is much more severe than originally. If we then move to say we are moving in more to a services firm that actually has some kind of investments taking place because you need some kind of infrastructure as a basis. We're not talking about the big telecom companies which have huge balance sheets, but smaller than that. So then we do have a slightly different structure on our income statement. we have less supplies compared to the previous ones. And since we're more into services, we do have more employee expenses than the other one, now 50% of sales. We have depreciation of one, and we do have, of course, less financial expenses, which you will see is driven by a lower debt level, and some taxes and a bottom line net income. The balance sheet that we start up with, we have much more cash here, which is more normal when it comes to more services and higher employee expenses. So the cash position originally is much higher here, but we generally speaking have smaller balance sheets here compared to the other one. The services industry drives smaller balance sheets. This one gives us key ratios initially with a cash to employee expense of 40%, cash to sales of 20%, and a current ratio of 2. So a very high liquidity in those firms in order to manage the liquidity risk that are potentially there with fluctuations. We do have a negative net debt to equity position and an equity to assets situation at 0.5 in this setup originally. So in these kind of industries, we see a sharp reduction in sales of 70%. We do see a reduction in supplies of 50% and a reduction of the employee expenses of 40% as a starting point. Where do we end up then? Well, we see here post that we have a very sharp decrease in both cash to employees and cash to sales, because we use up the cash, of course, in order to sort of manage our short-term payments. The current ratio also drops dramatically. But what you also see in this case that it's likely then that we will need to see much more debt, of course, given the fact that we're actually staying in business. And we do have a drop of the equity to assets ratio. So this could be one outcome for these kind of firms, sort of given, of course, that they do survive in the first place. The final setup that we're going to look at is services purely driven by human capital, i.e. virtually everything you do is related to face-to-face transactions. You need a lot of employees in the business. In this case, we have 70% of sales is actually eaten up by employee expenses, very small depreciations, and relatively little supplies of various kinds, though it's needed in the process. We do have a balance sheet that is mainly driven by current assets in terms of cash and other current assets, which is the total. A slightly smaller balance sheet than in the previous ones, and very, very little fixed assets, no debt moving in. This gives us, and I've entered the debt to equity ratio here as well, a starting point of 14% in the cash to employees, 10% in the cash to sales, and 0.67 in current ratio, i.e. very good liquidity, generally speaking. No indebtedness whatsoever, and a net debt to equity of minus 0.33 as a starting point, and a very, very high equity to assets ratio. In this case, we also simulate where the 70% reduction in sales, reduction in supplies, and 50% reduction in employee expenses. In this case, we end up in a situation where we see some changes on the liquidity side, but of course we need to keep some cash and we need to keep some of the current assets as well, because we build up in the little thing that we're actually doing. So the drop here is not dramatic. But what we do see in these kind of firms is, of course, that the cash situation is very similar to the income situation. So every cash drop that we take, which is dramatic in this case, also hits equity very, very quickly. So it's more a matter of survival than anything else. And what you see in this particular case is, of course, that you're still in a situation with a net debt to equity that is negative because we sort of forced it to have some cash left. But you see in the debt to equity situation that we're now also being forced to take up debt in order to survive at all. And I'm not going into any discussions here whether it is possible to do that or anything else, because that is, of course, an issue that needs to be addressed in the situation, generally speaking, in practice. We also see a sharp drop in the equity to assets ratio, as expected in this case as well. So these are sort of the frameworks. If we do believe that the company will continue to operate, that they manage to have these kind of reductions, etc. So this is sort of a way of approaching the problem. So what is effectively happening here? Well, from a mathematical point of view, what we do have is that we try to relate the owner profitability, the ROE on the left-hand side, the return on equity, income over equity. We do have operating profitability of the return on capital employed, and we do have the leverage effect of high debt to equity. So we see here that all of these firms that we're bringing in here, they do show a higher debt to equity situation after at least a prolonged crisis that we do see here. So the thing here is, of course, that that is fine as long as we in the future then will have a relatively stable operating profitability in terms of ROCE, or return on capital employed. However, if that is not stable, we will put ourselves in a position where the financial risk taking is maybe so severe that the return on equity and thereby the equity development in the long run will sort of not be good enough in order to sustain business if additional crises actually appear. Another way of thinking about that and structuring is to relate it in this risk diagram where we sort of need to balance the business risk and the leverage, i.e. the financial risk that you have on the y-axis and the business risk on the x-axis. Normally, you would like to be somewhere along the diagonal from A to D in order to balance the business risk with the financial risk or the leverage. What we do see here in this situation with the prolonged crisis, where we need to cover things with debt potentially, the issue is that we might actually be moving further upwards in the diagram towards into the B sector, where sort of the risk levels are generally high, or if you're lower on the business risk, you're being pushed up to the higher levels of the A sector in this diagram. All of those, of course, take you out of balance, and it will take quite some time to take you back without sort of getting additional capital injections from your owners in order to manage the debts, the equity situation, and thereby being able to repay debt. So if we think about this, there are a couple of issues here that we should take into consideration when we start and think about these things and analyze it. So first of all, we need to balance risk in the long run, as we pointed out in the previous slides. The potential for too high risk taking overall, at least in the medium term, that one is very, very critical and is very, very present. So the thing here is, of course, can we manage that? What happens if we run into a situation where we have another downturn, a second wave of the crisis of the COVID-19, for example, that actually hits the companies later on? If we're already in a worse financial position at that point in time, and then we bring that one on even further, that was, of course, increase the risk another step. But it doesn't have to be sort of the additional or prolonged second wave of the COVID-19, but we could just have downturns. And the question is, will the companies come back into a financial stability in due time for managing and coping with the next downturn? What we also then need, of course, to stress is the need for cash flow to service the debt. And these will require a couple of things. Of course, if we don't bring in financing from our owners, we need to do that internally by generating cash internally. What does that mean? Well, there will for example, be a requirement on generating margins. We need to generate more cash internally, i.e. the split between the cash ins and the cash out, also then materializing in terms of differences between revenues and expenses on the income statement. We need higher margins, driving EBITDA, for example. And that, of course, puts limitation into our relationships with other firms in the ecosystem and the value chain. Another way of generating cash flow That is, of course, managing your working capital. The lower you can make your working capital, the less you'd actually tie up in working capital, the more cash you will be generating. Of course, if we see those kind of things in the value chain or the industry ecosystem that we do have, the question becomes, who is actually going to finance that at the end of the day? Who will be the ones that will be helping out your subcontractors, for example, in the value chains in the industry? And these are exactly the questions that we need to ask ourselves. Can the system survive given these increased need for cash flows in every value chain level? And who will then be responsible for handling that? Well, I think that we can think about these in terms of a 2x2 matrix as we did the last time. And the question is, we can look at the firm and we can look at the ecosystem, we can look in short-term and long-term. So, of course, if we just look at the firm and we are looking at the short-term, we need to sort of rely, of course, first on the internal cash that we have, but then, of course, on external financing in order to manage this in the best possible way. If we look at the ecosystem in the short term, I believe that there is not going to be too much sort of saving the ecosystem because we need to save ourselves in the first. So make sure that your own house is clean, and that is sort of the structure that we actually see. If we look in the long run, on the other hand, the individual firms, we can end up, as we saw in our examples that we had previously, that if we manage it short run in a way where we sort of take up a lot of debt due to our liquidity problems in the short run, we might actually end up in a debt crisis in the long run. We are too indebted, we are taking on too much risk there. But in the long term and in the ecosystem, in the industries, the question is, who will the saviors be? And of course, there is a situation which we at least can elaborate on, where the sort of the bigger companies in those ecosystems, they need to really help out the subcontractors and the other ones in order to manage their cash flows and in order to cover their situation with respect to the debt situation they've actually entered into. That, of course, have big impacts on price negotiations and working capital management when it comes to credit days and these kind of things between the companies in the system. Because the margins that is particularly for the slightly smaller companies in the value chains, they will become more compressed and thereby put much harder constraints on these kind of companies. So my issue here, of course, when we start thinking about this is, where will the individual firms end up and what kind of effects on the relative impact in the ecosystem will we actually see, i.e. who will be the saviors, who needs to be the saviors in the system in order to manage the whole flow of goods and services that we need in order to satisfy our customers in the long run, like that. This was my input today when it comes to this. And so we are now going to send you out into breakouts. We're probably not going to do as many as 5 as I had on this slide. We're going to make slightly smaller groups. And for those of you who want to stay and discuss in groups and then come back and discuss with us, feel free to do so. If any one of you now feels that I break out and I stop this and I've taken the input and whatever thoughts that it might have given you, I say thank you very much for joining us, and I hope you have a great afternoon.